I've made videos in the past praising SCHD, JEPI, and JEPQ, and I hold all three of these ETFs in my portfolio. But I wanted to make it crystal clear that SCHD is superior for any long-term investment purposes. The last thing I want to do here is mislead any investors to making poor long-term decisions. If you invest in JEPI or JEPQ, stick around until I share the example later in this video. And this is not me trying to make a hook here. You will be genuinely floored when you see the long-term cash flow difference between SCHD and the JEPs. If the example doesn't faze you, please drop me a comment below with what planet you're from. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Let's grow. SCHD quick summary. We'll keep this section quick and simple here. SCHD is my favorite dividend ETF to hold for long-term investing. It is a replacement in my portfolio for what the traditional three-fund portfolio has as their bond section. It's a low-cost, passively managed ETF that holds 100 different dividend stocks. And I love the selection process that it uses for selecting the dividend stocks. It takes all the human gut decisions out of it. One perk of holding SCHD is its very respectable 3.76% dividend yield. Now that is only about a third of what JEPQ yields, but we'll dive into why SCHD provides superior long-term cash flow compared to JEPQ later in this video. SCHD has had a rough year on its price return and its total return, but if you stretch it out over the last 10 years, it's one of the most competitive dividend ETFs on total return. Its dividend growth rate is what boosts its value to seemingly unrealistic heights, and we'll take a look at how that works a little bit later. JEPI and JEPQ quick summary. JEPI is a covered call ETF. It selects stocks from the S&P 500 for its holdings, and then it writes call options on these holdings. JEPQ is the exact same concept, only it uses the NASDAQ 100 as its underlying index. In fact, the holdings in JEPQ have a 68% weighted overlap with the popular growth ETF, QQQ, which is based on the NASDAQ 100. So the JEPs make a little bit of qualified dividends from their holdings. They also make premium income from the call options. Both types of dividends combine to create a sky-high dividend yield. JEPQ has a trailing 12-month yield of 11.1%, while JEPI sits at 9.3%. The price appreciation is nerfed compared to the underlying indexes because of selling call options. The high dividend yield comes at the cost of stunting price appreciation. The dividend yield will increase or decrease based on the market's volatility. We can assume a long-term dividend growth rate of around 0%. Sometimes it's higher, sometimes it's lower, based on how juicy the call options are, but it won't consistently grow like something like SCHD that holds 100 companies that increase their dividend payments every single year. Long-term comparison. I recently reviewed a real scenario for new retirees that led me to creating a tool to check out some different investment strategies. They were torn between high yield, something like JEPQ, versus solid yield and solid growth rate, something like SCHD. And I'll be honest, that's what led me to the idea for this specific video. I realized that a couple of my recent videos could have caused a little bit of confusion for the reasons I promoted JEPI and JEPQ. I view them as amazing extra cash building replacements. Basically like a high yield savings account or a money market on steroids. But not viable long-term investments. Why, you ask? Let's have a look. Now, they did a great job of funding their 401ks throughout their career, and they ended with $2.5 million in their portfolio at the time they retired. This is fantastic. So what I did here was I took the information for SCHD, JEPQ, and JEPI from Seeking Alpha to get the current yield for each of the ETFs, as you can see here. And here's where JEPQ shines, that juicy 11% dividend yield compared to a mere 3.76 of SCHD. And I also took the current 5-year dividend CAGR. I plugged in 0 for these. I explained earlier, sometimes they'll go up and sometimes they'll go down, but it'll be based on the market volatility, and we won't see any reliable growth over the years for dividends. So it's safe to assume about 0 for the growth, and that's why you get these high yields, and the price will slowly appreciate too. This spreadsheet doesn't have any price appreciation. We'll check out just how much the price does appreciate of SCHD in my next example here, but we're strictly talking cash flows with this one. Here's the dividend growth rate, and here's the dividend yield. JEPQ. So what happens if we put it all into JEPQ, you look at this and you think, wow, that is a lot of dividends. For 2023, we would have $275,000 of dividends coming in. And now you look at this future dividend calculator, what I have here is with the 0 growth rate, you're going to have the same figure. And of course, in reality, it might be a little lower, it might be a little higher, but you're gonna have around 275K indefinitely with JEPQ. And what this is the purchasing power. So I am assuming a 3% inflation. You might go 2.5, 3 might be a little stiff, but I like to go 3 just to be conservative. This is what the dividend payments are worth in 2023 dollars. So as you can see, of course, when you receive the same amount of money, your purchasing power will go down as the years go on. That's how inflation works. So you go, now granted, this is many years later, but your $275,000 per year up in 2023 has become valued at what today is worth $100,000. Now here's the difference. You look at that $275,000 and you think, wow, that's amazing. And it is. Let's put that back to 0. And let's just do the other extreme, 100% of SCHD. So you get a much more modest 3.76% yield. That's if you put the money in today at the current price. Of course, the yield will change based on the price, but this is what it's worth right now. It gives you an even $94,000 per year. Now, $94,000 is a lot of money, more than enough for most people to live on when you also add in any pension income and social security income. But the beauty here is in 2024, you would be at 107,000, in 25, 121, and so on and so forth. You can see as you go down, that's the power of the dividend growth rate. You're already matching JEPQ somewhere in 2031 or 2032, and your purchasing power is only increasing because you're crushing inflation. See, this is what your dividends would be worth in 2023 dollars. So you're only living a better lifestyle and you're receiving way more money. And this is about to get kind of wild. It seems unrealistic, but this really is how the compound effect works. Again, with no money reinvested, you're taking these dividends and living on them. This is what your dividends per year is looking like as the years go by at that 13.6% dividend CAGR. When you're talking getting $15 million a year, $16 million a year, you think, okay, something's got to be up here. We are assuming a fairly high 13.69% dividend CAGR, but let's go over to Seeking Alpha and see if there's something goofy about the 5-year dividend CAGR with SCHD. So as you can see, the 5-year growth rate, the 5-year CAGR was 13.69%, and that's what I use in the spreadsheet. 5 years is the most common one. That's what it also has on the summarized scorecard. But over the last 3 years, it's been 11.4, and over the last 10 years, it's been 11. Okay, so let's use that 11. Actually, you know what? Let's use 10%. Let's be a little more conservative. We'll say SCHD is going to slow down on the rate at which it grows its dividend, down to 10%. You can see you're still smashing inflation. Your purchasing power here is going up over the years, and you still catch your JEPQ about a decade later, just over. So it's definitely worth taking the dividend growth if you can, if you have the portfolio value, as opposed to the cash flow. Now it's so tempting to fall into the yield traps and see 11%. Wow, it looks amazing, but it's so much more beneficial long-term, as you can see, to take less now and get the dividend growth later. Practice delayed gratification. 10-year SCHD example. So let's take a look at a scenario if this newly retired couple had dumped all their funds into SCHD 10 years ago. This will add more context to the example from before and just how it actually does grow like this. Because what I'm about to share on the screen has zero assumptions. This is exactly what happened over the last 10 years. Again, we can't assume the next 10 years will be the same. They're all going to be different. But this is a real life scenario that doesn't have any creative twist by me to make it look better than it really is. I took the most recent 10-year stretch for SCHD, which is 1/1/13 through 12/31/22. And so if someone was to retire at the very end of 2012 and they took the $2.5 million portfolio and dumped it all into SCHD, at the time it was $29 a share, so that would have afforded 85,970 shares. So these figures are all assuming dividends not being reinvested. We're taking the dividends and living on them. So the first year is 2013. I just have 12 in here for the data to calculate the growth rate. For 2013, for each share of SCHD you held, it paid 90 cents. And then 2014, for each share is 105, and so on down the line. In 2022, it's paying $2.56. So this is the year by year growth rate of the dividend. You can see usually double digits. This is what you compare to inflation or your old salary raises. And so the first year of retirement, you would have had $69,000 of dividends to live on. And then the next year, 78, up to 90. And you go down the line and all of a sudden you're living on $220,000 per year. And again, that's with the same exact amount of shares. But the reason I wanted to show this spreadsheet, it pays you some nice dividends. If you look at the last 10 years, so not counting 12, we just had that for the data, you've gotten $1.3 million of dividends. But at the same time, your price appreciation is $4.1 million. That's what your portfolio has increased by. Nothing to do with the dividends, just a straight up price appreciation. So now you're sitting on a $6.7 million portfolio and you've had $5.5 million of portfolio growth when you add the price and the dividends. So we've been focusing on the cash flow. How do I keep the cash rolling in and live a nice, comfortable retirement? But what you kind of forget about is just the value that something like SCHD will grow to as well. Quick recap, if you're looking to live off dividends in retirement, you're doing it right. It is a very smart move, and congratulations on choosing that path. Now, if you have a portfolio amount that can support the higher dividend growth holdings, you should probably go with that path and you'll forever punch inflation in the face, live on more and more money every single year, and leave a nice little pot of gold at the end of the day for your loved ones when you go. If you're far from retirement and you're looking to build massive wealth now during your career, check out this masterpiece right here that has outperformed the market for each of the last 10 years. Thanks again for watching, and I will see you here next Thursday, and sometimes on a Sunday. Peace.